Hello, this is Manesh Patel from Ichimoku Trade. Today is May 11th, 2016. Today I want to talk about an option trade that we took with Macy's, which is already at a 4 to 1 reward risk ratio. So I want to talk about a couple of different things in this trade review. One is money management, where you have to sit there and consistently try to get to a 3 to 1 reward risk ratio in order for you to be consistently profitable year after year, quarter by quarter, month to month. Second, I want to kind of talk about options and how what you could do is you could take options and use them differently in order to sit there and make money. So let's begin. First, before we begin, we're going to go for our normal disclaimer to state this is for education use only. We're not soliciting you buy or sell any particular instrument. If you do so, you're doing that at your own risk. All information is owned by EII Capital Group. It cannot be copied or distributed without our written permission. Remember, this is for education use only. Even though we're showing you a live trade, this is still for education use only. We are broker neutral, so we really don't matter what charting or brokerage platform you're using, as long as it basically supports Ichimoku. For today, since we're dealing with options, we're going to use Thinkorswim from TD Ameritrade to show you the real live trade in our accounts. Here's our contact details, so if you have any questions, you could contact us here at Manesh Patel at info@eiicapital.com, or you could call us at any of our office locations here. So let's go through and start looking at this trade. So about a couple of weeks ago, more towards the last week in April, we had our Options University. In our Options University, we kind of go through basics of options, and then we start going through very sophisticated strategies out there in order to sit there and start generating money for speculative reasons and also more towards investment type of reasons too. One of the strategies that we show in the Options University is what we call a pre-earning strategy. The goal is to take a earnings trade typically 2 to 3 weeks out minimum. So that's the minimum you should be going out. And what we're looking for is a dollar move, which is what we call a delta move, along with a volatility move too. Typically 2 to 3 weeks before earnings announcement. Typically and normally IV starts going up, so you get a bonus of Vega dollars. And also what you're trying to do is you're trying to look at the Ichimoku charts 2 weeks before that to make sure that you get the dollar move too. So this is Macy's. That basically, if you look at it here, today was the earnings date for Macy's. 2 weeks ago was roughly around here. So around April 25 is when we looked at this date, and I'll show you exactly when we put this trade on. We put this trade on in the Options University class after we did a full-blown analysis of it. So this is roughly when we took this trade. You could see that this is a weekly time frame where each bar represents 1 week, and the price was roughly around close to $40 a share at that point. And at that point, our goal here, based on Ichimoku, since this was below the cloud and below the green line, was to at least play it to the pivot low for earnings strategy. So our goal was to sit there, play it to the pivot low here. Once we get to the pivot low, if we got there before earnings, we'll evaluate it to see if we want to sit there and take it through earnings to keep on playing it down, or what we could do is we could take off all our positions for a nice little profit beforehand. So if you look at it, if it was roughly around $40 a share to the pivot low, it would have been about $34.28. Okay, so let's look at the risk graph. When we sit there and took this trade here, what the thing was is that since we took it 2 or 3 weeks out earlier, typically the IV is at its average value. When it's at its average value, you could pretty much buy calls and puts. Since we're betting on this instrument going down, we're looking at puts. We looked at here, so this is the put that we basically bought here, which is the July 35 put. Now, since we didn't want the theta decay, we wanted to make sure we at least close out this 30 days before expiration. So our goal was to close this trade out sometime in June. Typically, the reason why is that most trends last about 30 to 45 days. So if you look here on April 26 around, I would say about 1:57 p.m. Eastern Standard Time, during the class we took this trade here live, and you could see that we basically bought it for 56 cents a contract. Now, and this is my student account here, so what our goal is to always show people that you can make money off one contract. If you can learn how to make money off one contract 3 to 1, then all you do is increase the quantity size and you're able to get to whatever values you're looking to make on a monthly, quarterly basis and so forth. So here you could see that we bought it for 56 cents. Today we could sell it for $4.30. So if you look at this, we're over a 4-to-1 reward risk ratio at least right now. Okay. And today earnings got announced. So believe it or not, this value is a lot higher. And the reason why is we lost some value due to volatility, but that's not much at all. So if the stock stays at the current price right now and the IB starts to go up, this value will automatically increase to a point where we could probably sell this for over close to $5 or so. But anyways, if you look at this trade here, you could see that Macy's gapped down here over 15% today, which is a huge number. So at market open, we started seeing it going down, and we started seeing it going down drastically to a point we're definitely over 3-to-1 reward risk ratio on this 35 put. So what we did was, after we got to the pivot low, we took off 75% of our positions. Okay. We already declared profit on those. On the other 25, what we did was we turned this into, instead of a single strategy, we turned this into a vertical strategy. So what we did was we sold a 30 put against the 35 put that we had bought, and you could see that we sold it for $1 here. Okay, so if you look at this here, after we sold it here, sold it for 56 cents. So now what happens is, by selling that, and you look at the risk graph, I have zero cost in here at all. There's no risk for this trade at all. So if Macy's decides to go up today drastically, then I'm not going to ever lose in this trade. So I completely took the risk out by capping my reward. And what I did was, by capping my reward and giving it a limited upside, I took the risk completely out. So this is a free trade. Now if you look here, my maximum reward now I could get is only $500. So if Macy's is below $29.84 by July 16, then basically I'm going to walk away with $500 in profit. If it's basically anywhere from $35 and up, I lose nothing at all. If it's $33 at expiration, I'm going to walk away with $195. So this is basically a free trade. I have nothing to lose. 25% of my positions are pretty much set up this way to a point it's a free trade now going forward. If I want to sit there and take this off today, I could take this off today and get basically $309 in profit for every contract. So I got nothing to lose at all. This is a perfect way for you to sit there and get to create what we call residual income, something similar to your salary. What happens is as this instrument keeps on going down, I'm going to keep on locking in more and more profit, and it's going to start providing me a residual income. There's no risk at all in this trade, so nothing I really have to do to manage this trade at all. If you look at the charts here, this basically is closed right now. It's it's below this little pivot low here, and you can see on the weekly time frame it's still going down, and in the monthly time frame this thing still could go down. The next support is going to be roughly right here, and then the next support after that is going to be roughly right there. So you could see that we still have some more downside here where we could keep on making more money. But the key thing here is, in order for you to consistently make money, especially if you're dealing with options, you want to get to a 3-to-1 or 4-to-1. At that point, you want to take 50 to 75% of your positions off. Once you take them off, what you want to do is the rest of the 25% of the positions, depending on what the Greeks are for the options, you want to sit there and make this a free trade. So you have a huge upside. Even though you cap it, it's still huge. And then what you do is you completely take out the risk where there's no risk involved at all. This is the type of trades that you need to do where it's very safe, especially in a very volatile year that you have now, where the markets are basically consolidating big wild swings. You want to sit there and get to these points where these trades are free. And that's exactly what we basically demonstrated here on what it looks like. Okay, now we're going to put out some more trade reviews. We're going to show you some more other things, some other pre-earnings trades, some not 2 weeks before, but a day before or the day of the earnings. I'll show you Toyota Motors in the next trade review, where we basically took Toyota Motors before earnings and so forth. So there's various strategies we teach in the options university, but this is just one course here. The goal is basically get to the pivot low before earnings. We really didn't do that, so what happened is we took it through earnings, and at that point Macy's tanked and we got to a 4-to-1 reward risk ratio. We took 75% of our positions off, and the rest of those 25 positions we basically sold a strike lower 5 points lower than our current strike. And basically what we did was we took out the risk completely by collecting a premium to a point. This trade's free, and we have a huge upside at the end of it. Here's our contact details here. If you want to learn more, feel free to contact us at any time. Thank you and have a good day.